What's going on, guys? Welcome back to another video. Thanks for tuning into Stock Essentials. My name is Alex, and we're going to be going over the most anticipated earnings for next week. And there's going to be a lot of great options plays that we're going to be doing on some relatively cheap priced stocks. Obviously, we have some big name companies such as Zoom, DocuSign, as well as Broadcom, but the price of these stocks are pretty high, and it's not reasonable for people with smaller accounts to play these stocks just because of how expensive they can be. So we're going to be focusing on some of these smaller price stocks such as Chewy, ChargePoint, as well as PagerDuty. Some of these cheaper price stocks that's more affordable for a lot of our viewers here. So obviously stuff like Zoom and DocuSign, we're anticipating they're going to be having some really good earnings, some really solid earnings. These stocks have pulled back quite a bit from earlier in the year, and we're anticipating them to beat earnings and see a really nice increase in price. If you want to play those stocks, don't play options. It would actually be beneficial if you just outright bought shares of these companies. These are very good companies for the long term as well. They have definitely proven themselves during the pandemic with how capable their software is, and we're expecting some really good things for these companies, and they're definitely here to stay. But for this video, we're going to be going over some really good options plays on a few of the stocks we mentioned earlier. First one's going to be Chewy, which is sitting at a price point of $88.60. So relatively fair price stock during earlier in the year. It was actually up all the way at $120 per share. But then it's pulled back ever since, and now we're sitting in a really relatively happy medium price point of $88 per share. So if we take a look at the charts, we can see that we have a really nice support line here at $86 per share. So we can use that to our knowledge, and how we're going to be playing these options is to actually either sell cash secured puts, or if you have a really small account, just do some put credit spreads at the same strikes. So we're going to be doing weekly options, and the whole goal of playing options during earnings is to get into it and then buy to close, closing your position the day after. Because remember, after earnings releases, these stocks tend to get implied volatility crushed, which means that if the price of the stock hasn't moved a significant amount, all the options are going to lose a ton of money. And we can capitalize that by being options sellers. So that's my favorite strategy, and I love playing options during earnings because it's relatively safe and there's a lot of premium to be made around this time. So if we take a look, we can go pretty far deep in the strike prices. $86 was our support, so we want to do something like maybe an 85.5 or even an 85 strike cash secured put for $225 a premium. So lots of premium to be made. That's a pretty high return. If we take a look at our calculator here, we're going to be first calculating the collateral, which is going to be the strike price times 100 minus the premium we're going to be collecting, which is 225. This is our collateral. If we do 225 divided by 8275, this is our profit. It's going to be 2.7% in just 1 week. So very high chance of profit, over 70%, as well as a lot of premium to be made. If you want to be safer, go down to strike prices. And if you have a smaller account, you don't have $8,000 of buying power, you could do a put credit spread. So what you would do is you sell the 85 strike, and then you buy the one under it at $84 strike. As we can see, we're receiving a minimum credit of $37, putting down a collateral of $100. So the risk to reward ratio here is really solid as well. But of course, if it doesn't go your way, you're just going to lose your collateral. Whereas with a cash secured put, we just own 100 shares if we lose on the trade. So that's the pros and cons for those two options strategies. Next stock on our list is going to be ChargePoint, sitting at a price point of $21, and it's had quite a bit of pullback as well, down over 50% from its all-time highs. So relatively stable stock price at the $21 level, as we can see here. And if we take a look at the charts, we're gonna see some really nice support at the $21 price point. So we can safely sell some cash gear puts. As we can see, it really likes to hover around $20 price point, and we can use that to our advantage because we know that every time it tries to dip below it, it just got spot right back up. So just like Chewy, we're gonna be going to selling put, and we're gonna go be going down to the strike prices. Pretty good premium to be made here. What we're going to be looking for is either the $20 or the $19 cash secured put, which is a pretty good amount of premium. If we take a look at the $19 strike, it's going to be 27 divided by 1863 because we're receiving $27 of premium. 1873 actually. 1.4% in just 1 week. Pretty good return right there. If you want to be a bit riskier, this has an 82% chance of profit. Very, very nice option strategy and very, very nice premium to be made. If you have $19,000 of collateral buying power, you could sell 10 of these and collect $270 of premium, or you could do the $20 strike price and receive a pretty good amount of premium, $54. And your chance of profit is really, really high as well at 73%. So this is going to be a stock that I am looking forward to on Monday and selling some cash puts on, just because of how stable it is around this low $20 price point. Next stock on our list is going to be Li Auto, which is a Chinese automaker, and it's been doing relatively well. We're going to be looking to sell some puts on it as well around the $27 price point. As we can see here, really, really nice support. Double dip at this $27 price point. So we're going to be looking to sell a cash secured put at 27 or below that. So as we can see here, we're going to be looking to either sell at 27 or 26.5 or even the $26 strike cash secured put. So yeah, I'm looking forward to the 26.5 strike cash secured put, and chance of profit is relatively high as well at 82%. So very, very high chance of profit, and you can sell multiple contracts of these for collecting $32 of premium per contract. It's a really, really nice option strategy here on a relatively cheap price stock. And the last stock on our list to sell puts on is going to be PagerDuty, and they have been pretty stable recently around this this high 30, low $40 price point. Take a look at the charts. We're going to be looking to sell some cash gear puts around this really solid support line at $37.50. So let's head over to the options chain. Of course, this one doesn't have too much volume as the others, so we don't have as many expiration dates. We're going to have to sell cash gear put for September 17th, which is about 2 to 3 weeks out. But that is fine because we're just going to get in and we're going to be getting out after earnings. That's our plan with these strategies. So the premium for these are they're okay. $35 cash gear put, you're going to receive $50 of premium, but very, very high chance of profit, 85%. And as you saw here, really strong support at this 37.5 strike level. And we're selling a $35 cash gear put, so relatively safe strike price and really solid support around the $38 price point. If you want to be a bit riskier, you could do this $40 strike. It has a 68% chance of profit, and you're collecting a pretty good amount of premium, $183. So if you are pretty bullish on the stock, then this would be the one that you want to do. But overall, I would recommend this. I don't like to take too much risk, and $50 for $3,000 of collateral is not that bad. If we take a look at the profit, it's going to be $50 divided by 34.50, because remember, it's the strike price times 100 minus premium collected, which is going to be 34.50, and that's a 1.4% return in just this is actually 1.4 return in two and a half weeks. So the profit here is going to take a little bit longer, but overall I do think that's pretty nice strike. If you want to be a little bit riskier, of course, do this $40 strike. It does have a lot of time on it left, September 17th, which is 2 to 3 weeks from now. so you have a lot of time for your contracts to play out. But our main goal with selling these cascade puts is to buy them prior to earnings and then close them out right after earnings once implied volatility gets crushed. So obviously, we don't know if all of these plays are going to be winners, but the more plays you have, the more diversified you are, and the more chance you're going to be in the green for the week. So that's about it for this video. If it helped you in any way, please leave a like, comment down below what your thoughts are and what you're looking forward to this week for earnings. And of course, subscribe to the channel if you're new here. It helps out a lot. Thanks for watching.